Welcome back to Finance Friends. I'm your host, Fabian, and this is season 4. This season, we're diving deep into the world of investing. Not just where to put your money, but how to think like a professional investor. We are bringing you conversations with highly intelligent, incredibly motivated investors. With weekly episodes, make sure you stay tuned in. Welcome back to Finance Friends, season 4. Can't believe it. To kick things off, we've got Andrew McKie. He's the co-founder and MD of Alston Asset Management, one of the leading Australian investment management firms based out of Queensland. They specialise in multi-asset portfolios via managed accounts and also large cap and small cap Aussie equities. Andrew is super insightful. He started his career studying economics before working the family business, which is car dealerships, and then working as a stockbroker, before he realised that he prefers to manage money long-term rather than focus on transactional investment advice. He shares his insights around his investment philosophy, talked a lot about monopolistic investing, as well as the difference between growth and value investing. Make sure you have a listen as we kick things off because he is a gem. Andrew, welcome.
Fabian, thanks for having me.
Good to have you in Melbourne.
Yes.
Just talking about
Melbourne.
Crazy wind yesterday and pollen in the air. So if we have a coughing fit halfway through, please excuse us.
Yeah, thank you for the peppermint tea, mate. That was a nice touch. Appreciate that.
Well, I make sure I look after my guests, especially if they make it a special gift, a special travel from Brisbane to come see us.
Yeah, coming down to Melbourne for the good weather. Right? So,
And so have you always lived in Brisbane?
I was actually born in Townsville. So, yeah, so Queenslander through and through. So all your New South Wales listeners just turn off now, if you like. But so, yeah, Townsville and then Brisbane mostly when growing up, yeah.
Yeah, I did a few trips to Townsville. I'm not sure I was seeing someone in Townsville for a while.
Oh, yeah, okay, right.
Yeah, I realised it's not the place for me.
Yeah,
It's
okay.
a beautiful place nonetheless.
Yeah, you would have been the quality flying into Townsville, mate.
Yeah, interesting.
Yeah, yes.
Yeah.
No, it's an interesting place. Nice and warm.
So you went to high school in Townsville, is that right?
No, I was like a baby basically there, and then we moved to Brisbane when I was probably 5 or 6.
Okay.
My parents were from North Queensland, so a little country town called Serena, which is just outside of McKie.
Yep.
So they sort of travelled around a bit for work and things and then moved to Brisbane. Yeah.
And what did your parents do for work? And the reason why I ask is, did that have an influence on you and your career?
Oh, I think it definitely did. I mean, not, salubrious background, you might say. So both left school, I think, sort of grade 9, grade 10. So dad was a apprentice motor mechanic. Mum worked at the council there. And then, just a good lesson in sort of progress and opportunity that's in Australia to, if you work hard and you've got ability, you can sort of go well. So, he went, from apprentice motor mechanic to mechanic, so then sales, and then eventually ran dealerships and then eventually got to buy a dealership. So he was in the new car franchise dealership network, so I had a few of those. So so definitely that philosophy of investing in your career and working hard, and the opportunities will come. But also from a business point of view, he had a good business. He looked after the team really well. I think he understood inherently that the business is really just a collection of people sort of coming together.
Yeah.
And you got to look after the team. They look after customers, and if you build a philosophy around that, you'll have probably a pretty good business.
Yeah, I think that's obviously important. Team and culture sort of drives business.
Yeah, exactly.
So at what point in your life, was it during high school that you started wanting to study business or do finance? Or was it sort of a later thought in life?
Yeah, I wasn't sort of the best student. I think probably, around the kitchen table, learning a lot around, business and managing people, and I guess the stresses of business, from a young age. Probably good at sort of maths, despite myself, was pretty good. So then, just got an interest in that probably later on in high school, and went down that sort of accounting, economics sort of route, and then, probably last year started studying, and then got to uni and just did economics at uni. I did like the broader sort of thinking around economics and sort of the behavioural aspects, and also the cyclical nature of the thought processes that goes into that, and the sort of consequences and so on. I think that's helped a lot in investment career as well, because it's it obviously has a huge influence.
Yeah, I think macro plays a more important role than micro.
Yeah.
Obviously, everyone has different thoughts on that. So then when you finished university, what did you do?
I came out in the pretty deep sort of recession in the 90s, so wasn't a lot around, so scratching around. I got a job with Westpac in their graduate program, so I had sort of a bit of experience through various parts, but the boom part of the industry at that time was credit collections, because obviously we're in recession. So I started
High
out,
interest rates,
So I started, ringing people up, basically collecting money for the bank. So that was interesting. Progressed right through to repossessing cars when you were 21. So it was an interesting.
I hope you were going to the gym back then.
No, I certainly wasn't. So I don't know if I'd probably leave my actual name, when I was recording a message there. So, but yeah, that was a good, I guess, insight into perhaps making bad financial decisions. Worked, in even credit approvals, and back in the day, like a Harvey Norman, interest-free loan, then converted to a 33% interest loan if you didn't pay it off in time, so that sort of stuff. So, yeah, there was some good foundational parts of that. So, yeah.
And how did, from that position, what can you talk me through? Let's just keep going through your career. I want to know how do listeners all want to know, how do you go from being an economics student to possessing cars to leading, one of the largest, the massive investment management firm?
Yeah, I think you go from there to, I think, always do further studies. So that was definitely the case. I did work in the family business for a few years, whilst also studying. So I went back and did graduate diploma in applied finance with Finzia, and then I also did a graduate diploma in financial planning with Finzia, and whilst working in the business, and that sort of also gives you a foundation in investment markets as well as financial planning, I guess, back in the day. And then decided to leave the family business. It wasn't sort of my go, and worked in stockbroking. So I got a job with one of the larger firms in Brisbane, and that's sort of where the career and sort of equities went from there.
Yeah, so you're a stockbroker, because there's many stockbroker, or were you an equity analyst at a stockbroking firm?
No, stockbroker. So I started on the sort of desk, and then just gradually sort of learnt the trade from there.
So what does a stockbroker do back in the, what is it?
90s, 2000s, yeah. Look, it's sell side basically. So, versus buy side. So just a very different philosophy, you might say, to an investment buy side person, particularly longer term. So, ultimately the business model is geared around transactional, turnover. And so ideas and, generating those ideas were critical. And I think although that was a good foundation of understanding businesses and understanding investors and understanding markets and things like that, probably didn't really resonate with the conflicts there in terms of perhaps long-term investing versus, the short-term need from a business model perspective of generating turnover. Yeah. But, you learn from a lot of great people as well. It's a very well-established firm, been around over 100 years. So, there was a lot of history with that firm, and a lot of great knowledge there as well.
So for our investors, listeners that might not know, a stockbroker will get research internally or research their own companies that might be listed in Australia.
Yeah.
Then they'd call their clients or email their clients, say, hey, I've got an opportunity that we think this company's going to go well.
Yep.
Do you want to buy this company? And then you will charge a fee to make that transaction.
That's right. I mean, the two revenue streams for most stockbroking firms are transactional turnover, so brokerage.
Yeah.
And then the other one is corporate finance. So there's a related, they're related in the sense that a lot of the broking side is, seen as distribution for their corporate. So they'll do, obviously capital raisings and new IPOs and placements, might be equity and debt. And they distribute that through, their broking network. So both in retail and institutional. And they have an underwriting fee as well. So they're the two main revenue streams for most broking firms. Still the case today. And it's a necessary part of the industry, but it's just whether or not that sits with your broader investment philosophy, I guess.
And can you recall an IPO back in the day that you were very excited about when you're working as a broker and you brought to your clients that has been a success story today?
Oh, look, I think one of the most interesting ones was actually the ASX demutualisation. Yeah. So back in the day, every state had an exchange. So they were all, the New South Wales Exchange and the Queensland Exchange, and they merged to become the ASX, the Australian Stock Exchange. They had members who had a seat at the exchange, and for that seat, they were able to, do trading and so on the exchange. And it was a mutual, so they demutualised. And so if you had a seat on the exchange, you got issued shares in the float of the ASX. Per member, I think back in the day, it was like 167,000 shares if you were a member of the exchange back then. So, what they are today, whatever they're $70 a share or $60 a share. So, they did very well out of that. But that was an interesting sort of process. And, a good lesson there. One of the sort of older heads, one of the partners sort of there who was a member of the exchange. I was a young person going, do we buy it? What's the target price? Is it something we should buy? And he's just leaned over to me and gone, it's a monopoly, just buy it. So I think that resonated from a quality of business over sort of price of the stock. So that, over the long term, a quality sort of business, monopolistic power, pricing power, competitive advantage, they shine through. Whereas in the short term, you get a bit obsessed with the immediate price of the business itself. So that was a good lesson.
So have you taken that lesson to the way you invest today and look for companies that have, monopoly in their market or, that creates pricing power? Yeah.
I think Rupert Murdoch said it once that, monopolies are a terrible thing unless you own one. And so I think they're it is a foundational part of business. If you have pricing power and control of, the price of the product you're selling, regardless of what it is, usually you've got a higher return on capital and better cash flows and more robust sort of business. And so those principles of what makes a good business, they may not all be monopolies, but they could be monopolistic in the way that industry is structured or the way they built their business. So I think that goes to sort of security of your capital longer term and more robustness of that business. So one would be, say, like a Michael Porter, who's Porter's 5 Forces, which actually goes through, what are the 5 forces of competitive structures, and it helps you to sort of identify really good businesses, control of their suppliers or customers and so on, the likelihood of substitutes coming in, those sort of things.
Yeah, the barriers to entry, et cetera.
Correct.
And Australia, we're not big for pushing competition.
No.
We love to have individual or dual or full banks, for example.
That's it.
Can control market share.
Yeah, it's an interesting global dynamic in Australia that, and we're a large cap, so we're ASX 100. And one of the reasons we sort of say it's good in Australia is you end up with these sort of concentrated market positions. No one really knows why. One of the reasons is that perhaps, we have a large geographic sort of area, but reasonably small population versus the US, say, where you've got reasonable sized cities, and there's a lot of them, that 5 to 10 million, and so they can have a reasonable business start in one of those cities and then grow from there. But perhaps with us, that constraint of geography doesn't allow that to happen so much or so easily. That's one of the reasons that are out there. But you name an industry, you're probably looking at a fairly, like you've already said, duopoly, cartel, monopoly type structure often in large cap. So you're already sort of part head of the game.
Yeah, well, I guess for them to get to ASX 100, they've probably had some stranglehold over the Australia market.
Yeah, that's right. But it's just a unique Australian thing.
Yeah.
Yep.
So then from stockbroking, how long were you in that role for?
So really started in that and then switched to more the wealth side probably in 2008, and that's when we started the business. And from there was more, we started as more of a wealth management business, so more traditional planning, which is the planning background that I had as well. And then from there we went to really, we were a very early adopter of managed accounts.
Yeah.
IMA, so individually managed accounts, and also then SMA, so separately managed accounts.
So what's the difference between the two for our audience?
The IMAs, if you looked at the three main structures, you've got a unit trust, like a managed fund. You've got a SMA, which is essentially a model portfolio, but it deunitizes the investment, so you can have direct portfolio, but there's one model.
Yeah.
An IMA will still have typically a model portfolio, but they're individual customizable portfolios, whereas under an SMA, everyone gets the same model. You know, they all get the same portfolio, even though it's direct ownership, which has distinct structural advantages over unitized investment. Cash flow management, tax management, and so on. But it's sort of like the next level up in terms of tax optimization and customization is an IMA. Yep.
And given you were one of the first businesses to launch managed accounts, what made you do that?
I think originally, if we look back at Hub, Net Wealth, those platforms development, it was about deunitizing investments and how do we do that scalably? You know, how do we manage a direct portfolio professionally, and not have all your money in a unit trust, have it directly owned for all the tax advantages. And they were sort of very obsessed with that, and we had a similar view. We think that ultimately provided great benefits to investors, and so I'd go along to the independent Society of Managed Account Providers, and they'd all be there and we'd be there. And back in the day, it was a bit of a cottage industry, to be honest. And we just thought ultimately it goes well for advisors if you're a good advisor and you would be conscious of tax and after-tax return management, structural sort of discussions for clients. You're trying to maximize after-tax returns, minimize fees, all those things. If you are like that, then that has a distinct structural advantage. So that's why.
And obviously operational efficiency, I would imagine, because if when you're a stockbroker, you'd have to place, 20 of your clients, you call your clients, they all want to buy the ASX.
Yeah.
Then you'll have to do 20 calls, 20 trades.
Yeah. And the same with financial planning as well. If you really saw the explosion of managed accounts that occurred post Royal Commission, and the reason for that is just the compliance burdens on financial advisors. So whether it be a stock or an individual fund, if they have to switch, there would be a record of advice required. That's administration, perhaps a phone call, and so on. The financial advisor typically will run out of steam at maybe 20 clients if they're ringing each one.
Yeah.
So what you also find is that it led to inequity. Often it was the biggest clients that get the phone call, and the smallest clients were last to hear about anything, or the change never happened because it was just slow, manual sort of processes for financial planners. And so there's an equity thing there, I think, and all clients are getting treated the same and get the best execution in a sort of timely manner. And I think also what you see in the financial planning industry is that because of the administrative burden, the changes to the portfolio usually occurred at the annual review. So the best time of the year for Fabian's portfolio to be adjusted just happened to be the day that you did your annual review with your financial advisor, and nothing else happened throughout the year. That didn't really fly in modern world, and I think modern investors expect more than that from their advisor. They expect them to be a little bit more proactive than that, and I think that's an enabler as well. So we sort of saw that coming and saw the advantages to investors, advantages to advisors, and we were lucky to sort of come in at the back of that sort of tailwind for the industry.
So when you started the business, how many partners were there? And did they all come from the previous stockbroking firm that you were working at?
Oh, it's a bit of a mix now because the two main businesses, still got the wealth business, so we still understand advisors. and the pressures for advisors. I think there's symbiotic relationship there. There's a lot of learnings, and then there's obviously the asset management team as well are also equity holders. So there's a bit of a mix of both.
Yeah. So can you maybe share a little bit of information about the business and the name of it, how big you are, and how many employees? And
Yep. Elston is a business. So Elston Private Wealth, we look after about $2.5 billion in that business, and that's private individuals, typically self-funded is our market, maybe not ultra high net worth, but average portfolio size is around 2 million, and most of that is IMA customizable portfolios from a tax point of view. And then asset management, so Elston Asset Management, and we are specialist managed account providers, mostly multi-asset class. We do also have Australian equities, both large cap, which is the team that I'm in. There's 6 in that team. And then we also have emerging leaders, Aussie equities as well, which is X100. Yeah. So we cover the sort of range. There's a multi-asset class team that do all the selections and due diligence on managers, both passive and active managers across the main asset classes outside of equities. And then we have, equities team that do that directly.
Yeah. And what's your role within the firm?
So I'm managing director of the overall group. So my role is more strategic. So where are we going? We're doing that strategic cycle at the moment. So that's a 3-year cycle. So I get involved in that, trying to formulate, where we're going in a broad context, keeping strategy pretty simple, and then just really focusing on execution and making sure the executive team are focused on that execution, culture, stakeholder thinking, that sort of thinking goes into strategy as well for our business. So that's my role, but it's not a sort of full-time gig. My day job is in Aussie Equities large cap team. So there's 4 portfolio managers on one of the 4, and then we have a team of analysts as well that we work with. Yeah.
So can you explain? You've talked about monopolistic characteristics of a company. That's obviously one consideration when you look to pick stocks. Mm-hmm. Can you share your investment philosophy or process with our audience?
Look, I think one of the advantages of Elston is that we do have 4 portfolio managers. We all get a vote, and we also have all different views. And so I think that dilutes the potential risks of having biases. Everyone's got behavioural biases and styles, things like that. So I think that's a good thing. It rounds that out. For me personally, I'd be more of a style agnostic person. So I would look at businesses, if you might say, on a relative basis. So the way to explain that, I guess, is that every business has a value. It's just determining the growth of that business and the quality of that business to work out what that value should be. If you look at, say, multiples, I think people don't understand multiples well. Say if I pay 10 times PE for a business versus, say, 15 times PE for the business, it's hard to sort of conceptually get that. And why would you do that? I think the best way to explain it is to inverse that in terms of what is your return. And people can relate to returns a lot better. So if you pay 10 times earnings for a business, your return is 10%. You're going to get 10% return back in terms of the profits that you've purchased. So it's easier to understand that. Now, if you pay 30 times earnings for something, you get 3% return on your capital. So why would you do that? Yeah. Why would you willingly get a lower return? And so understanding that there is a linkage between the valuation and the growth and the quality of that business. So you might pay 30 times justifiably if that's a 3% return is doubling every 3 years versus the 10% return might be static and not growth. So you can only relate, or values of businesses only are relatable or relative to something else. Yeah. So growth, quality of those businesses and so on. So that's sort of my view is that, you can have variety rather than being sort of style. These are growth type businesses. These are value type businesses. No, it doesn't really matter. They all have their own valuation. What you need to look at is the relative context is what's the growth of that business like? Is that justified in terms of its valuation? Yep. It's a different level of thinking about it.
Yeah, because it's one thing, past growth is no guarantee of future growth.
Yeah.
as well.
And I think, that's why a higher quality business should get a higher multiple, because it is more predictable.
Yep.
So you don't know what earnings are going to be for any business. So, it's a big guess, really.
Yep.
It's where glorified value is at the end of the day. We don't really know what's going to happen with markets. You certainly don't know what's going to happen with businesses. But as you get into those structures of businesses, they're more predictable. Therefore, you have more certainty. Therefore, you can pay more for that business.
Yep. So is there an example of a company that you have invested in, I don't know, say the last 5 or 10 years that's done exceptionally well?
Yeah.
And can you maybe share a little bit insight into your thesis behind that investment?
Yeah, I think something like Macquarie Bank, we've owned for 13, 14 years in the portfolio. Probably bought it was $25 or something. It's $230 a share. But really, why I guess is that it's the culture of that business. It's the sort of freedom within boundaries, risk framework, the entrepreneurial nature of that business, and its ability to adapt over time and drive more quality. Then it's geographic expansion.
Yeah.
So and they tend to go in niche. So they might expand into Brazil, and they'll have a small team that has a particular niche. It might be in, I don't know, derivatives or something, and then they build relationships from there, and that's how they expand the business geographically. So, if we look at it long term, their opportunity set is enormous. So if you versus, say, a domestic Aussie bank selling residential mortgages, you're a pretty limited sort of.
Where do they go?
Yeah. So I think that's a great business and great example of why culture, environment is really critical, and strategy is really critical, longer term thinking.
And do you get to meet the management of these businesses to get a feel for the culture?
Yeah, sure. Like one of the things that we try to work through is that, every CEO tells you how great their business is. So you have to be a bit of a cynic.
Yeah.
And so you need to really be sure. And so one of the ways of being sure is trying to test them out on what they say they're going to do versus what they actually done. So execution is way more important than strategy. So you can have a great strategy. They can talk about their 10-page, PowerPoint deck of what they're going to do. But if they don't execute on it, or they haven't executed in the past, they've got no sort of management sort of credibility. So execution always trumps the strategy. And so their ability to execute over time is way more important. So actually historic versus forward-looking execution.
Ability to deliver.
Yeah.
It's interesting. When I did my MBA, I heard a interesting line that said, culture eats strategy for breakfast. I don't know if you've heard that before.
Yeah.
So it's one thing having a strategy. It's the other thing, having the people to be able to execute it.
Yeah, you can have and complex strategies over simple strategy. So like a great example, I think we've just added Seek in the portfolio. It is monopolistic in Australia as well, but Seek has 3 strategies. They want to take market share, so want to increase their market share in placements. They want to increase prices over time, and they want to have operating leverage, so discipline around their costs. So they've got 3 strategies. That's it. The hard bit is executing on that strategy. Well, so you want to increase your market share, but how do you actually increase your market share? That's not easy to do. So then it's the detail of how they actually go about execution of that. But simplicity is also critical. If you've got a 10-point strategy plan and, they execute 2 out of the 10 pointless, you're better off to have 3 and execute on all 3.
Yeah.
So, a good example of simplicity of strategy execution.
It's also easier to have your followers on board if they understand and know the strategy.
Yeah.
It's not too complicated.
Correct. And if it changes every week and you new strategy every week, the team gets really confused with that. So, you've got to sort of put the flag on the hill and go for it, give people certainty and they understand where they're going. And I think that that's important as well.
Yeah. And what about an investment you've made that hasn't gone right? Mm-hmm. What did you learn from that?
Oh, look, as fund managers, you get there is no ego because it gets beaten out of you very quickly. It is a race that has no finish. So, Just name it. I could thousands of things I beat myself up about.
Yeah.
Now, it can be something you've bought that's gone down, but it equally can be something you've sold that continues to go up.
Yeah.
That's a painful
harder.
experience as well. So, they're just as painful.
I know. I sold a stock about 6 months ago.
Oh, yeah.
And then rare earths has taken off, and I've
Oh,
just
no.
left 75% on the table.
Yeah, it goes nowhere for 10 years
Yeah,
and then
then
suddenly
6
has
months bang,
3
yeah.
months bang. But so look, I just think it's a constant learning, and that's why it's such a great trade to be in and profession to be in. And I think it's humility comes along with that, because you just have so many errors along the way and you beat yourself up so much. I think Kerry Packer said it really well. If you could be right 60% of the time, you'd end up ruling the world. He would end up ruling the world, because the probabilities and the percentages are just stacked a little bit in your favor. But it means you're going to be 40% wrong.
Yeah.
Now, in investment markets, it's probably 55-45 at best.
Yeah.
So you got to get used to being wrong in the industry and overcome that and learn from that, and then try and just get better over time.
The thing is, if you invest $1 in a business, you can only lose $1, but that dollar could turn into $10 if the business goes tenfold.
Yeah.
So your upside's uncapped and your downside's capped at your capital.
That's right. Yeah, and Macquarie's a good example, $25. Anyway, along that journey, GFCs, there's been a long journey along there. COVID, there's always a broker report, sell side experience. There's a broker report every day about Macquarie, whether target price, sell it, buy it, whatever. Got to get the transaction going. You almost need to ignore that and just flow through with the longer term quality of that business. So, and if you could have sold it many times over in that journey. So and paid the price for that.
Yep. And the business that you're a part of, Alison, how would someone invest in in the fund? So you have the Australian Equity Large Cap Fund,
Yep.
the Australian Equity X100 or emerging
emerging
companies,
leaders, yep.
and then you have a managed account option.
Yep.
So how would someone access that?
Look, most of our clients on asset management, we look after about $6 billion there. Most of our clients are actually financial advisors, which is why we need to understand the advice industry really well, because a managed account is a practice management solution as much as it is an investment solution. So to access us, typically it's through a financial advisor. Now we're on, I think, most of the major platforms, 8 or 9 of the major platforms, and managed accounts are typically multi-asset class. So going from conservatively constructed to right up to sort of high growth, maybe pure Australian equities. Yeah. And so, that's usually how you access. Not to say that you can't access us directly. You can access us directly through the platforms as well. You don't need a financial advisor.
So
but that's
you could
where
set up like a net wealth account and say I want to invest in the Alston Aussie Equity Fund.
Yep. And, we're just extending that as well. So, for example, we've just launched income SMA. So we're looking more at the issues for advisors where they've got different demographics to deal with, and aging population. So income security, moving a lot of people, baby boomers typically are moving now into that drawdown phase. So cash flow matching. So we've built a specific model variant for that. That's true to label in terms of income generation, more certainty of income, predictability of income, both in terms of the equities component, but the non-Australian equities component as well.
Yeah.
And we're currently incubating more of a high growth version as well, so a high growth SMA. So an advisor can, have got a younger demographic who's looking to accumulate, assets. They'll be, say, ASX 100, but the higher growth businesses. Yeah. The combination of that portfolio with the emerging leaders as well. So they're sort of put together. And then the exposures outside of Aussie equities are also growth type managers as well. So they're all true to label in terms of their components, and allows an advisor to bring their client through that journey or target specific demographics of client. And it can also be for tax. So you could have the growth will typically have lower turnover, lower realizations. Yeah. So someone in a higher tax entity would go into that. They'll pay less tax on a capital gains tax point of view. Equally, the income version might have more turnover, so more realizations, obviously more income, more franking credits and so on. So someone who's got, say, a capital loss that they want to absorb, over time through realizing capital gains, that would be – so you can also overlay tax optimization at the advisor level as well. So
and also a lot of people that will need income are probably, investing through their super fund and in pension phase. So
franking credits, rebates.
Tax-free at this point. Who knows what will change in the future.
That's right.
As governments put their hand on the big pool.
Yeah. It was a shame. I just saw recently that Reece – Reece Plumbing just did a buyback of their shares, and they, it's pretty tightly held by the Wilson family, so it's not a lot of shares around. So they actually did it off market. So people just submit their shares that they want bought back, and the company buys them back. But prior to 2022, you could do that as a structured buyback, where the listed company could buy it back with, say, a smaller capital component. So in this case, it was $13. They might give you $5 of capital, and the rest would be a fully franked dividend with the attached franking credits. So it was a way of distributing franking credits out to the owners, to the shareholders. That's been stopped from 2022. I think it's a real shame. It's still available for private companies, but it's not available for listed companies. And I think, in Australia, those franking credits are owned by the shareholders. That is their asset. Yeah. And, limiting the ability to distribute them is, I think, a real shame and something I think that should be changed.
Well, you think in a private company, that's how you do it.
You could buy back stock all day long and do that and distribute those out. But, they're a tax-free, risk-free advantage for Aussie investors. And, the company's paid the tax on their behalf, and they deserve to be able to receive those. So they made some particular comments around that as well, which was good.
And might just towards the end, and I know you have to fly out. So where do you see the market in the next sort of 3 to 6 months? Because it seems like everything's quite expensive around at the moment. Most assets are at record highs.
Yeah. Look, anyone who tells you what they think the market's they know what the market's going to do is, lying, basically. So, we don't know what's going to happen with markets. Anyone can. So, but what we do know is that there's certain things where you don't want to participate at this stage. And so it's easy in Australia's Aussie equities context to sort of avoid certain areas. And I think outside of those certain areas, there's a lot of actually opportunity. And it's related to a particular market dynamic at the moment, which is momentum-based trading. So momentum is not fundamental. It doesn't matter about what I was saying, in terms of multiples and growth and, quality of business. It doesn't matter. That's out the door.
It's pretty much charts.
Yep. If the share price is going up, then you buy, and if it's going down, you sell. If it's 10 times earnings, it can go to 2 times earnings. If it's on 50 times earnings, it can go to 100 times earnings. Doesn't really matter. So, there's those momentum driven opportunities, because if you are a fundamentalist with a long-term view, you're presented those opportunities all the time. You're gifted these opportunities. And so we see a lot of these sort of gifts at the moment. And when that changes, and there's a change from being purely momentum-based, who knows when that will be, but then you'll sort of reap the rewards of that. So we see a lot of opportunity out in some of those sort of names.
Yeah, no, awesome. Thank you very much for coming in. It's been a pleasure.
Yeah,
got to know you over the last few years, and you're a client of Riva Recruitment, so thank you. I've heard you present many times, and I'm sure our audience will get a lot of insight from our discussion today.
Thanks a lot, Fabian. I really appreciate the invitation.
Cheers. Thanks for listening this week. Stay tuned for our next episode and keep up to date with us by following the Finance Friends podcast on Instagram and TikTok. Plus, connect with us and our guests over on our LinkedIn page, all linked in the show notes.
Disclaimer. This podcast exists for informational and entertainment purposes only. The personal opinions of the speaker and guests do not represent the view of any other party. If this recording contains reference to financial products, that reference does not constitute advice nor recommendations and may not be relied upon.